What if your money could work for you while you sleep? That's exactly what dividend investing does. Hi, I'm Mile, and I'm here to show you how dividend investing can make your money work for you. So, what exactly is a dividend? A dividend is a cash payment companies share with investors from their profits. You don't have to sell your stocks. The company pays you a part of their profits just for being a shareholder. You might be wondering, why should we even care about dividends? Think of it this way. Dividends lets your money start working for you instead of just sitting idly in your account. Every time you get a dividend, you can reinvest it to buy more shares. And when those new shares pay dividends, you can reinvest again. It's like a snowball rolling down a hill. Each year it gets bigger and bigger. That's compounding. And it's how small payouts today can grow into a substantial income over time. Here's how compounding works. Let's say you invest $100 in a stock that pays 10% annual dividend. Each year you use your dividend to buy more shares, letting your investment grow bigger and bigger. Watch how your money grows. There are two main ways to invest for dividends: individual dividend stocks and dividend ETFs, exchange traded funds. Let's start with individual dividend stocks. These are single companies that regularly pay dividends like Coca-Cola or Apple. You buy shares directly and receive dividends based on the number of shares you own. For example, if Apple pays $1 per share and you own 10 shares, you earn $10 a year. The downside is that your income depends on the company's performance, so diversification is limited. Dividend ETFs. These are baskets of dividend-paying companies like SCHD and SPYI. Buying an ETF gives you an instant diversification, spreading your risk across many companies. ETFs are great for beginners because they simplify dividend investing while still providing steady income and long-term growth. Many investors focus only on price growth, hoping the stock's value goes up over time. That means they're relying entirely on the market to increase their wealth. Dividend investors, on the other hand, earn cash flow along the way. This cash can be spent, or even better, reinvested to buy more shares. Over time, reinvested dividends often outperform price growth alone. Here's my actual US dividend ETF portfolio. SCHD dividend yield 3.86%, VYM dividend yield 2.15%, main dividend yield 7.33%, SPYI dividend yield 11.73%. If I invest $100 across these, my portfolio's average dividend yield, assuming equal allocation across SCHD, VYM, main, and SPYI, is roughly 6.27% per year. That means for every $100 I invest, I earn roughly $6.3 per year in dividends. But here's where it gets powerful. If I reinvest those dividends every year, that small income keeps growing. Over 10 years, my $100 can grow into $184 just from reinvesting dividends. That's an 84% total return without trading or chasing price gains. It shows the power of dividend investing, where even a small starting amount can grow steadily over time. If this helped you understand dividend investing, hit like and subscribe to follow my journey here on Yieldcraft.